Good day and welcome to Vaibhav Global Limited Q4 and FY23 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Disha Shah from Adfactors PR. Thank you, and over to you, ma'am.
Good evening, everyone, and thank you for joining us on Vaibhav Global Limited's earnings conference call for the quarter and full year ended 31st March 2023. Today we have with us Mr. Sunil Agrawal, Managing Director, Mr. Nitin Panwad, Group CFO, and Mr. Prashant Saraswat, Head of Investor Relations. We will begin the call with opening remarks by Mr. Sunil Agrawal on the business operations, key initiatives, and a broad outlook, followed by discussion on the financial performance by Mr. Nitin Panwad, after which the management will open the forum for Q&A sessions. Before we get started, I would like to point out that some statements made or discussed on today's call may be forward-looking in nature and must be viewed in conjunction with the risks and uncertainties that we face. A detailed statement and explanation of these risks are included in the earnings presentation, which has been shared with you all earlier. The company does not undertake to update these forward-looking statements publicly. I would now like to invite Mr. Sunil Agrawal to make his opening remarks. Over to you, sir.
Thank you, Disha. Ladies and gentlemen, thank you all for joining us today on this earnings call. It is my pleasure to share Vaibhav Global Limited performance for Q4 and FY23 today. I hope you would have reviewed both our results and presentation that provides details on business operations and the current market conditions. We sincerely apologize for any inconvenience caused due to the short duration between the release of the results and the earnings call. Let us begin by discussing the quarterly performance. Sales for the quarter were rupees 693 crores, an increase of 1.1% from rupees 685 crores in the fourth quarter of last year. However, our top line had a stronger growth of 39.2% over last pre-COVID period of Q4 FY20, which is a CAGR of 11.7% during this period. The top line performance was in line with our guide, but could have been better given the continued macro environment weighing on the consumer sentiments. Our vertically integrated supply chain, combined with a strong global sourcing reach, provides us with a competitive advantage and allows us to maintain a robust gross margin at 51%. EBITDA for the quarter has been at 8% of the revenue versus 6.9% of Q4 of last year. YOY improvement in EBITDA is on account of operational efficiencies and cost rebase activities. Sequentially, the margin is lower owing to relatively leaner season vis-a-vis Q3. I would now like to touch upon each of our addressable retail markets. In UK, economic headwinds continued with subdued consumer demand. This had an impact on revenue. However, we are taking all mitigating measures like focus on lower price products by increased airtime allocation for under 10 and under 20 pound products. In US also, the current macro challenges are weighing down consumer sentiments and resultant demand. We are continuing to augment our reach by adding more TV cable and OTA households, and today our coverage in US is higher by 4 million households YOY. We have also initiated additional marketing in OTT or connected TV homes where the customer LTV is very high. We believe in seeding investments for long-term growth. Recently, Salesforce Marketing and Salesforce Service Clouds have gone live in US and UK. Now our websites, marketing, and customer service portals are all integrated. This enables us to give a great customer experience through integrated email, SMS, chat, website targeting for upsell, cross-sell, as well as precise retargeting on web, etc. Our strategic partnership with Vodafone Cable Networks in Germany has enabled us to extend our reach to additional 13 million households, thus expanding our presence to approximately 90% of total households in Germany and Austria. Having achieved this milestone within 1.5 years of launching retail operations is encouraging and positions us for much stronger future growth. Our continued market share gain across territories demonstrates our ability to adapt and navigate any economic environment. Our vertically integrated supply chain has worked well for us. The low-cost manufacturing and value sourcing enables us to serve value-conscious customers in our addressable markets in US, UK, and Germany, thus achieving industry-leading gross margins. Besides lower costs, our vertical model also helps reduce new product turnaround time, excellent storytelling opportunities, and better control over design and quality of our products. Our 4R framework comprises of reach, registrations, retention, and repeat purchases, forms the basis for driving operational performance. The reach of our TV networks by the end of FY23 was 141 million TV homes, which was 124 million in FY22, that is 14% higher YOY. We reach TV homes through cable, satellite, telco networks, and over-the-antenna-based TV platforms. Our products are also available on digital channels, including all proprietary websites, smartphone apps, OTT platforms, marketplaces, influencer marketing, and social direct response. New registrations during 12 months were 3 lakh compared to 3.18 lakhs in FY22. This is significantly higher by 69% over pre-COVID period. 57% of new customers were acquired digitally versus 56% in FY22. Customers bought an average of 23 pieces on TTM basis versus 27 pieces in corresponding period of previous year. Finally, our retention rate stood at 38% on TTM basis compared to 40% of FY22. Both repeat and retention were slightly lower due to higher price points and adverse economic environment. At Vaibhav Global, we recognize the importance of creating a positive and conducive working environment for our employees. During March quarter, Vaibhav Global Limited India was recognized with the Great Place to Work certification for the 6th consecutive year. On sustainability front, this quarter we distributed 100 additional e-scooters to employees free of cost for official commute purpose. With this, a total of 184 e-scooters have been distributed, resulting in reduction of 12 buses from the fleet, saving approximately 70 tons of carbon emission per year. This quarter, we touched the milestone of generating 11 million units from our solar power plants on cumulative basis. As stated earlier, we intend to become a carbon neutral in scope 1 and 2 greenhouse gas emissions by FY31. Further, I am delighted to share that VGL's SEZ unit in Jaipur has been certified as Net Zero Energy Building status by IGBC. This is a major achievement by VGL, as till date only 15 projects across entire India have been certified so. I would like to take a moment to share our continuous efforts of giving back to society. Through our Your Purchase Feeds program, we have served approximately 70 million meals to underprivileged children in US, UK, and Germany till date, with current run rate of 50,000 meals every school day. This initiative aligns with our values of corporate social responsibility and making positive impact on the communities we are part of. Amidst the current macroeconomic challenges and the ever-changing landscape, our outlook for the future remains positive. I would like to reiterate our current guidance and outlook for the business and are confident to deliver 8 to 10% revenue growth in FY24 and to deliver mid-teens revenue growth in subsequent periods with decent operating leverage. We remain committed on maintaining balance sheet strength alongside returning meaningful cash to shareholders. The board has recommended a final dividend of rupees 1.5 per share, which is subject to shareholder approval. Including interim dividends, total dividend payout against earnings of FY23 would be rupees 6 per equity share. With this, I now hand over the call to Nitin to discuss financial performance. Over to you, Nitin.
Thank you, Sunil. Good evening, everyone. Let me now start with the discussion on quarterly financial performance. Revenue for the quarter was rupees 693 crores, a year-over-year growth of 1.1%, which was in line with our guidance. Our focus on offering value-conscious buying options has resonated well with customer demand. In comparison with Q4FY20, the growth is 39.2%, implying a CAGR of 11.7%. Had the broader economic environment been favorable, the performance could have been relatively better. In local currency terms, Shop LC US and Shop TJC UK, a decline of 12.1% and 4.6% respectively in sales. The decline in sales is attributable to weakened consumer sentiments, inflationary environment, particularly energy in UK, and recessionary fear in US had an impact on the demand. However, we believe this is to be temporary in nature. Germany is scaling up well, with revenue and customer numbers increasing every month. Having associated with Vodafone, one of the largest cable TV network provider in Germany, the growth has further accelerated recently. Though we expect a short-term impact on profitability due to the additional airtime cost, but the same will be covered up in future as revenue from new households starts to kick in. At operating level, we are confident we will break even in this territory by H2 FY24. For the quarter, our TV revenue was rupees 409 crore and digital revenue was rupees 256 crores. Year over year, TV revenue declined by 1.7%. However, digital revenue grew by 2.1%. Against pre-COVID period of Q4 FY20, the growth is encouraging, with TV growing by 25% and digital by 51%. TV refers to our proprietary TV channels that includes free-to-air channels, that is OTA platforms. Digital includes our proprietary website, shopping apps, OTT platforms, marketplaces, and social commerce. Digital continue to perform better than TV segments owing to wider discovery potential. Our core focus to promote and encourage customers to transact on both TV and digital platforms, which gives them a unique shopping experience. And such omni-channel customers tend to have significantly higher customer lifetime value than customers that buy only on TV or only on digital. For financial year 22-23, the budget pay revenue mix was 39% of retail revenue. During inflationary environment, budget pay offers affordability to customers to buy even high ticket size items with ease. As far as our product mix is concerned, jewelry accounts for 73% of our total retail sales and rest 27% comprises of lifestyle products, which includes apparel, home decor items, beauty and accessories. Gross margins during the quarter came in at 61% owing to our vertically integrated business model. EBITDA margin for the quarter was 8% compared to 6.9% of Q4 FY22. Historically, Q4's EBITDA margin had always been lower than Q3. Being a linear period versus Q2, it is at par. Efficient pricing, product mix, and continuous cost rationalization were key focus areas of the group during last year. And we endeavor to continue the cost rebase momentum in future as well. Profit after tax for the quarter is rupees 23 crores against 27 crores of last year. Operating cash flows were at 126 crores for FY23 against 86 crores of FY22. Free cash flow of rupees 90 crores in FY23 against negative 214 crores of last year shows the impact of capex reverting to normalized level. ROE and ROCE of 9.1% and 14.4% respectively reflects impact of subdued profitability during the year. The board has paid dividend of 4.5 rupees per equity share during the first 9 months of FY23 and have further recommended final dividend of rupees 1.5 per share subject to approval of shareholders. We are committed to creating enduring value to our stakeholders by striking a harmonious equilibrium between growth, investment, and regular payouts. As we move forward, I would like to reiterate our earlier guidance and outlook for the business and are confident to deliver 8 to 10% revenue growth in FY24 and to deliver mid-teen revenue growth in subsequent periods with decent operating leverage. With this, I hand over back to the moderator.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Anyone who wishes to ask a question may please press star and 1 at this time. The first question is from the line of Ankur Kumar from Alpha Capital. Please go ahead.
Hello. Congrats for a decent set of numbers in a tough environment. Sir, one question, when you say we will expect decent operating leverage, so we are at our peak, we made 15% EBITDA margin. So you think we can reach that number over, say, a 2 years period?
Thanks for the question, Ankur. We would strive to reach back or across 15.3% that we achieved in FY21. So, but we are not giving a specific guidance how soon we'll reach that. But our effort would be to reach that as soon as possible.
Got it, sir. And sir, for the coming year, what kind of employee cost increase and other expense increase can we expect? Because you're saying revenue will grow 8 to 10%. So I just wanted to check on these two numbers also, about expected growth on these numbers.
So employee growth and? You're asking for employee and?
And yes, employee growth and other expenses. So because other expense would include logistics also, which should have come down. So what kind of numbers can we expect on these two fronts?
So they will grow lesser than the revenue growth. Therefore, the leverage. We are not giving specific guidance on specific expense heads, but leverage will come because they will grow lower than the revenue growth.
Got it, sir. And sir, on Germany side, we were talking about break-even from the second half. So are we sticking to that number? And what is our loss for Germany in this quarter as well as the full year?
Yeah, just one moment.
Yeah, so Germany right now, as we recently had our partnership with Vodafone, we are seeing improvement in sales. So we are keeping the guidance that by H2 we will make a break-even. But right now we are around 60% of the what sales need to be achieved. So 40% that is required more, which is almost $1 million per month net sales additionally is required to get the break-even numbers.
And what was the loss?
So last quarter is flattish compared to the same time of last year. It is almost around 1.5 million euros somewhere, and it is similar as last year. However, in the presentation, if you see, there is a forex difference because of rupees forex difference. There is a gap of 0.3% down in EBITDA level, but in local currency terms, it is flattish compared to last year.
Sorry, you said 1.5 million euro loss for the quarter.
Yeah.
That is in Q4.
That is sure, sir. Thank you and all the best.
Thank you, Ankur.
Thank you. A reminder to our participants, please press star and one to ask a question. The next question is from the line of Pradeep Mehdi from RGI Private Limited. Please go ahead.
Yeah, I want to know that why the company has decided to expand its new business at Germany and Austria. Why not in other countries? What are the advantages company look in the future? That Germany and Austria, they can grow more.
Sorry, Vijay, I could not understand your question. Can you repeat, please?
Yeah, I can repeat. Why the company has decided to expand its new business at Germany and Austria? Why not in other countries?
Yeah. So thank you for the question. Germany is considered to be a large economy comfortable with long distance shopping. That is the television and e-com shopping. And the economy is bigger than UK. And we had a past experience in Germany. So we felt comfortable going into Germany. And other markets in Europe like Italy and France, they are smaller markets. And in future, we may go into those markets as well.
Okay. And one thing, how the company will improve its net profit percent in the future? I mean, FY24.
Yeah, we are not giving guidance of net profit, but we do give guidance that we'll grow 8 to 10% this year with operating leverage. That means if we are making 8% EBITDA the last financial year, we will have higher EBITDA in this financial year, that is FY24, with 8 to 10% revenue growth.
Okay. Thank you, sir. Nothing else.
Thank you.
Thank you. Any participants who wish to ask a question may please press star and one at this time. The next question is from the line of Aman Gupta from Credent Info Edge. Please go ahead.
Hello. Thank you for taking my question. So my question was about the changes in inventory finished goods.
Use the handset, please. Your voice is not very clear.
Yeah, sure. Is it audible now?
Yes.
Yes, it is.
Yeah. So the change in inventories of finished goods. So last year, it was like minus 168 CR, and now this year it's 21 CR. So I just want to understand where this have we added new inventory or moving inventory from other parts of the country like this?
So let me take this question, Aman. So the inventory level, which is showing increase over last year, is mainly related to rupees devaluation over last year. But in local currency terms, in US dollars, it is declined. Last year, same time, we had a group-wide $84 million inventory, which is reduced to $78 million in this year end. So the impact you see is related to mainly rupee devaluation.
Okay. And what are your marketing expenses in digital and TV?
Yeah. So affiliate cost comprises roughly around 8% of our business, and digital marketing cost is our increase in past year, mainly related to our conscious investment in digital learning, expansion of new customers.
Okay, understood. And this D2C brand, that Fancy and Rachel Galley, so what are the growth there, and why are you only targeting women which are 40 years above? Why not the other women also?
Yeah, this is Sunil. That's a good question. I'll answer that. So our TV audience is largely 40 plus women who have time on their hand, and they have needs to get the company from live hosts from us. So they have time on hand and they are lonely. So we give them company, give them education, give them live communication. So we answer, we call their name out, so they feel engaged and they watch us for a long time. So our product development skills are geared towards that demographic. And that demographic is increasing in size and affluence. in our geography, that is US, UK, and Germany. So we remain focused on that demographic because that will continue to grow for many years to come. And that is what we've done for our digital channels as well.
Okay. And this Tamsi, that D2C brand, which we acquired previously?
Yeah, so that we initiated about a year and a half ago. So they are growing, not as fast as we would have liked because of the macro environment. So we scaled back the earlier planned investments into marketing. Even then, they both are growing year over year in terms of revenue. Still small base, but they are increasing revenue also from the cost perspective. So the marketing spend as a ratio of revenue is improving sequentially year over year.
Okay. Understood. So thank you.
Thank you. The next question is from the line of Ankur Kumar from Alpha Capital. Please go ahead.
Hello, sir. One question on the logistics cost. Can you please explain? Can you please tell what is the logistic cost for this quarter and the full year?
Sure. Thank you, Aman. So let me now. So logistic cost.
Just one moment.
Hello, sir. Are we connected?
Yes, I have the number. So for the quarter, our shipping cost was about $6 million compared to $9 million last year. And for the year, it was about $25 million versus $33 million last year. This is the shipping cost at the retail level, not the shipping cost. This does not include the shipping cost from our supply chain over to our retail unit.
Got it, sir. And sir, do we expect reduction in this to continue because things should have reduced in terms of costs?
So largely the cost reduction was owing to the lower volume this period. There was some renegotiation that we were able to achieve with carriers as well, but largely with the volume reduction. But so the guidance that we have this year is to a similar price point, and the volume will increase. So cost will increase in proportion to the volume.
Got it, sir. Thank you and all the best.
Thank you, Ankur.
Thank you. A reminder to our participants, please press star and 1 to ask a question. The next question is from the line of Nayan Gala from Etica Wealth. Please go ahead.
Yeah, hello. Can you hear me?
Yes.
Yes.
We can hear you.
Yes. Thank you for the opportunity. Actually, I joined a bit late. So if you can just, give a breakup of the revenue between TV and digital.
So TV and digital, so it's for the quarter. TV and
for the quarter and full year, both.
For the quarter, TV revenue was 416 crore rupees and 250 crore for the digital. And TV has a degrowth of 1.7%, but we have growth of 2.1% on digital. For a full year terms, we have 1,699 crores TV sales for full year, and 1633 crore rupees sales for the full year, which compared to 1699 of last year in TV, and digital 977 crore rupees sales compared to 986 crores of last year. So we have relatively lower degrowth on digital for a full year. It is 0.9% lower degrowth on digital compared to TV is 3.9% degrowth.
Okay. And in terms of the EBITDA margin, will there be a significant difference when when the sales happen through the TV or maybe through digital? So what will be the difference in terms of the margin?
Yes. So let me answer this, Sunil. So digital is pretty well connected with our TV business. Within digital, we have three components. One is the live streaming goes through digital platforms. The second is the catalog, and the third is the auction, $1 auction or £1 auction. So the first two components, the TV and as well as catalog, their margin is similar to television, but the auction is much lower because there is a clearing mechanism of TV inventory, the tails and the dogs which are left over, that we did through $1 auction because we have vertical unit. We can't return that product back to the vendors. So we clear that most of those items through this $1 auction, and that margin is around 15 to 20% only, compared to 50s, 60s in TV and web.
Okay. And this, sir, just wanted to know a rough, figure as to, the $1 auction that we do, that would be how much of the total yearly revenues? A rough estimate would be fine.
Yeah, it's 5% of the total business sales for a unit.
Okay. And over the year, this has been around this level, or it has gone down? If you can just comment.
Relatively similar ratio.
Okay. Yeah. Okay. And sir, I was just going through your presentation. In that you have mentioned that you have tied up with Vodafone, wherein in Germany, wherein now you are targeting around 90% of households. So if you can just help us understand the kind of opportunity that is there, and how we are going to, and what will be the time frame for the same to capture this 90% of the household.
So Vodafone is 13 million homes out of total 36.
Out of 42 million, also in Germany and Australia.
Yeah, so out of 42 million homes, Vodafone is 13 million homes. It is not completely 90%, but now we cover 90% of Germany and Austria after addition of Vodafone. Now, the TV homes, they take anywhere from 6 months to 18 months to become fully mature. Now, break-even of those homes differ from platform to platform. Some platforms start to break even in 4 or 5 months. Some platforms take 8 to 9 months to break even. So this is still very new, and it is ramping up pretty good. And that is why we have fairly reasonable confidence that we will break even in H2.
In H2 of FY24?
Yes.
And sir, what is the capex amount that we have incurred, or what is the capex amount that we are going to incur?
For particular Vodafone investment?
Yeah, for this investment.
Yeah, so it is a OPEX. There is no CAPEX in this. It is a broadcasting rights. So we pay it on monthly basis what service we use.
Okay. And any similar plans in different geographies that we have?
Yeah, we continue to look for additional airtime in US especially. There's still a lot of distribution on OTA that is still available to us. As we get opportunity, we continue to distribute. Now, there's no such right away availability, But whenever becomes available, we have a team looking for that airtime, and we find an opportunity, we take it.
Okay. Yeah, thank you, sir. This is all from my side. If I have few questions, I will come back to the queue.
Thank you.
Thank you.
Any participants who would like to ask a question at this time, then please press star and 1. The next question is from the line of Ritik Tulsian from Concept Investwell. Please go ahead.
Hello. Yeah, am I audible?
Yes, you're audible.
Yeah. Hi, sir. I have few questions. So, in FY23, we got a benefit of currency depreciation, right? And assuming this year, that is in FY24, we don't get the same benefit. So, given that, how confident are you of achieving the guidance for the full year? Because if we see UK and US, the demand is not materially improving, right? So, how confident are you?
Yeah, so our guidance does not take into account the exchange devaluation or exchange fluctuation. This is for so we expect to go 8 to 10% in constant currency basis. And there may be some element of foreign exchange fluctuation that will come in, but we have not factored that in at this time.
Okay. And so you have said that you are gaining market share, right? So in which geographies you have gained market share? Is it all three of them, or the specific UK and US only?
So we look at our competitors who are in these geographies, US, UK, Germany, and who are addressable and publicly listed entities. And against those entities, we have gained market share consistently over last many years. So the data I have in front of me, for the last 4 years, we have consistently gained market share.
So in both the geographies, UK and US, right?
Yes, UK, US, and now as we are going into Germany, we are starting to include Germany as well in our calculations.
Okay. And how was the growth in the month of April 2023? Like, if you cannot quantify, but just give some, highlights on how was the growth.
We cannot give a guidance on specific period, but we are confident of achieving 10% for the whole year in current financial year.
Okay. And one more question I just have, that is, if I see, the geography-wise margin differentiation. So in America, we have significantly low margins when we compare it with UK and India. So why is there such a, gap between margins when we compare it between geographies, specifically America and UK? So what is the difference? What accounts for this difference?
Yeah. So we have a similar kind of margins. You are mentioning about gross margins, right?
The one you have uploaded in the results, the earnings before interest, tax, and exceptional items.
One second.
Yeah.
Yeah. So actually, for the comparing to previous years, the LC in Shop LC, we have the margins, our higher labor costs and shipping costs that we are seeing in US. The territory is quite big. Normally our shipping cost is higher in Shop LC in US market. And in UK, it is much lower shipping cost. That is coming in bottom line profitability better in UK in previous years. Also, the affiliate cost also in US, it's much wider and bigger market in affiliate side. So affiliate as a cost percentage compared to UK. In US, it is higher. So that is why in financial year 21, if you are referring, or 22, it is the PAT margin in UK is better than US.
Okay, that's it from my side. Thank you, and have a good year.
Thank you, Richard.
Thank you. The next question is from the line of Rupesh Tatia from IntelSense Capital. Please go ahead.
Hello, sir. Can you hear me?
Yes, Rupesh.
Yeah, thank you. Thank you for the opportunity, sir. I haven't had the opportunity to go through the presentation yet. So sorry if my, the data is there. My first question, sir, is what was our content and broadcasting cost for FY23?
Yeah, just one second. The content and broadcasting for the full year, it is 273 crores compared to 233 crores of last year. So it's a full year cost.
Okay, and do you have kind of like what is the budget for FY24?
Yeah, the budget actually in the last yearly it is related to Germany investment that we have done it. It was not as high airtime cost at that time. So the new Vodafone venture we have taken it. So that will be additional over the top of it. But normally we see based on the opportunity comes up. If any airtime is giving a profitability based on the cadence that we have decided, we always ready to take the opportunity.
Okay, but do you have kind of some range, sir, you can give?
It's almost around $35 million.
Okay. And sir, in annual report 22, you had this broadcasting rights of 75 crore. So what is the depreciation policy on that? Amortization or depreciation?
Yeah. So it is a perpetual broadcasting right that we have for the perpetual period that we have taken it. So we are amortizing it in 10 years.
Okay, and that what is the value at the end of FY23?
Yeah, so usually it's a perpetual right. We don't really need to amortize, but as a prudent business principle, so we are amortizing it over 10 years.
Okay. Then sir, my second question is, can you give me the number of unique customers for FY23?
Yeah, so what is your question?
What is the number of unique customers for FY23?
It's a 461,000 unique customers for FY23.
So that number has gone down, right? If my memory serves right, it was 5 lakh for FY23 too?
Good memory.
Yeah.
That has gone down slightly, and that is owing to higher price point. Our ASP was higher, and the economic environment was tough.
So how do you see this number moving in FY24 and then also FY25?
Yeah, we expect it to go up in FY24 and coming years with additional Vodafone distribution that we have, as well as the digital investment that we are making. We expect it to. We're not specific guidance, but we expect it to go up meaningfully in current financial year.
Okay. Thank you for answering my question, sir.
Thanks, Rupesh.
Thank you. The next question is from the line of Rohan Mehta. As an individual investor, please go ahead.
Yeah, hi. Good evening, everybody. I'm sorry I had got disconnected in between, so pardon me if some of my questions have already been covered. So with regards to our lifestyle products, how are we seeing Germany panning out compared to our as against our past experience of UK?
So for lifestyle in Germany, as we are new in the Germany and we have a brand authority in jewelry. So historically, we are doing past 40 years in business in jewelry. We know and we manufacture the products. So we are more comfortable in initial period in jewelry side. However, the percentage to sales of lifestyle product is not as in UK, similar in Germany. So, but as soon as we will see the customer behavior on the lifestyle products, then we'll start increasing the lifestyle share in Germany. But majorly it is around roughly 18% of the 18 to 20% of the Germany sales is through lifestyle products.
Okay, I see, sir. And on the same lines, speaking of opportunities in Germany, Is it too early to say if we are targeting any particular new segments to penetrate the German market, apart from the ones you mentioned?
So, LSP is a very wide segment. We continue to explore new product categories and bring those categories for our customers. Your question is about the product, or what is it about?
So about the end segments that we might be targeting to get into with the German market. Like you said, jewelry is right now at a particular stage. So if you have any other end segments in mind with the German market?
Yeah, we already distribute apparel, fashion, accessories, some beauty, some home. And within these segments, they are pretty wide segments, and our buyers and merchants travel to all over the world, and when they find right opportunities, they bring those. And they also do the trend spotting, and wherever they see something trending, they would bring those products in. So it's a completely space for us to explore and take the opportunity, capitalize on.
Right. Understood, sir. And so, prior to this Vodafone acquisition, we had about upwards of 60-odd% of coverage in Germany in terms of households. And after the Vodafone acquisition, it has grown to around 90% odd number of households. So the differential that has been added, was Vodafone exclusive to these households in Germany, or was there also an overlap of this market share that we have gained? So basically, whether only new households were added, or can there be additional inflow of revenue from this new synergy from Vodafone?
Yeah, it's largely exclusive because people have to pay per month. And they usually do not pay to two carriers on a monthly basis.
Right. That's all right. And sir, if you can just shed some light on the gross addition of households that we have had in the US, in the UK, and now in Germany, except Vodafone, barring Vodafone.
Yeah, just one moment.
Sure, sir.
Yeah, US, we added 4 million new homes in the period, in the quarter, and UK was...
Hello?
Did I answer your question? US was 4 million and Germany, UK was flat. And
flat, okay. Germany was, sir? I'm sorry, I missed your number.
13 million Vodafone homes.
Okay, sir. And these are net of any households that we've lost, or these are totally new additions?
Yeah, they are net.
Okay, all right, sir. And just one last question. Our platform, is it only the platform that is the key differentiator vis-a-vis our competition, or do we have any product? Is there a certain niche within our product differentiation also when compared to other similar companies?
The biggest thing is the value perception. We position ourselves as the best value player because of our vertical model, and we keep relatively average price point lower than competitors. And within that, we excel in jewelry because of our long history, and other products also bring in lower price point than competitors. Therefore, the value perception becomes more.
All right. Understood. Fair enough, sir. All right, so that was all from my end. All the best. Thank you.
Thank you. The next question is on the line of Ashish Shah from Business Match. Please go ahead.
Yeah, hello, sir. Sir, I have a few questions on your slide 19, which talks about your own brand portfolio. There's one data point over there that the current revenue mix is about 30%. So could you give us a rough idea of what would this number be a couple of years back?
Yeah, just a moment. We don't have the data right now, Ashish.
Okay.
It has grown steadily, because we do focus on bringing products under certain brand so as to create affinity with that customer who likes a certain brand. And the repeat purchase usually goes up if someone has a certain brand.
Correct. And so, this revenue target mix of 50% by FY27, does this dramatically alter your margins and working capital profile positively, like over the next few years?
It improves repeat purchase of those customers. Margins, we are not taking any meaningfully more margin in brand.
Okay.
Our objective of brand is to create better affinity and better retention.
Okay. And so lastly, on that same slide, do you have any thoughts of acquiring any licensing or licensing brands to achieve the same objective? Or do you want to seed your brands, or you want to pursue the more inorganic opportunities?
Usually when you take up known brands, if it's say Disney or other brand, the margin that we need, 60%, is usually difficult in those brands. So we would avoid brands that will not allow us our 60%.
Okay. And so one other question, not related to this, you mentioned to the previous participant that our differentiation has been this lower ASP. However, ASP has gone up quite sharply. So, sir, any thoughts over there?
Yeah. So recently, because of inflationary environment, a lot of people have shown affinity or interest in gold products, like gold chains or gold rings or gold pendants. And we've taken benefit of those opportunity and offer to those customers. However, we believe that this is not a long-term phenomenon. As the business goes back to normal, ASP would settle back down a bit.
Okay, sir. Thank you very much.
Thank you, Ashish.
Thank you. The next question is from the line of Aditya Mehta from GK Capital. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. Firstly, one of the previous participants asked about broadcasting and content costs. You mentioned 200 odd something crores. So could you please repeat that figure?
Yeah, just one moment. Yes, sir, I agree.
Yeah, so that was 415 crores.
415 crores. Okay. So where do we see this cost going forward in FY24? Since most of our investments have been done right now.
So this cost will increase, but lower than the revenue growth that we are projecting.
Okay, and about the employee cost?
Again, lower than the revenue projections that we are projecting.
Okay. And secondly, my question is with regards to, do we have any data point from which we can compare the performance between OTT versus OTA homes? Because since the world is moving towards OTA home, and experience over OTT is totally different from an OTA. So any data point like per household revenue in OTA versus OTT?
Yeah, OTA is similar number as cable home or satellite home, but OTT lifetime value is more than double of TV home, because the app download, once they download the app and start interacting, there's a stickiness around the app behavior.
So any revenue per household number?
So we look at lifetime value, so it's about $1,500 on OTT versus about $800 on television.
So approximately double of OTA.
Yes.
Okay, thank you. Thank you. I'll get back in queue.
Thank you.
Thank you. The next question is from the line of Parth Dalal as an individual investor. Please go ahead.
Hello. Can you hear me well?
Yes, sir. I can hear you.
Thank you, sir, for the opportunity. So the question is, so I'll take you back to the history, let's say 4 years, 5 years back, when management's opinion was that the business model of Vaibhav Global is such that, we will grow faster during such unfavorable economic environment because people tend to move from the brand to the value provider like us. So the question is there any change in the business model since now we are, waiting for or anticipating the unfavorable economic environment to change to favorable for us? So any change that has happened?
Yeah, thanks for the question. So, I remember saying that, and I still stand by of gaining market share in any environment, whether it is a recessionary environment or economically robust environment. That we continue to gain the market share owing to our value proposition. Now, the current environment is a combination of multiple factors: the war nervousness, the inflationary environment, and as well as the recessionary fear and interest costs being up. So people's disposable income has been severely impacted. Our product is still not necessity; it is discretionary. And in such environment, discretionary product will take a hit for all retailers of discretionary product. Compared to other retailers, we continue to gain market share. 4 years ago, when now we have gained market share.
And that is the reason I assume we are moving the focus towards the $10-$20 products, basically the low ASP products. Is it that reason?
Yes, especially in UK and Germany, we are seeing more impact of gas prices and the food costs and the interest costs. So there we are giving more airtime for lower price point, and we are seeing customer interaction better in those price points.
I still believe we could have done that, a couple of quarters back. But anyways, I think we are moving it now. And another question, sir, is around the B2B. Again, years back you were saying that it will reduce, but I think last 2 years it has been increased. And even if we compare this quarter year on year, had it not been B2B, we would have been in red in terms of top line for the quarter. So how do you see that trending now?
Yeah, so we take opportunity because our manufacturing capacity was idle and our retail units were not fully lifting the product. Our ASP went up, so we did approach other retailers, and they were happy to give orders to us. And then we took opportunity of the capacity that we now for going forward, we'll continue to have a relationship with those retailers as long as we continue to get ROCE for those businesses. If that continues to give us ROCE, we'll continue to expand and capitalize on that. Because our capex for expanding on the capacity whenever we will need is relatively very low.
Okay, sir. Thank you. I'll come back in.
Thank you. The next question is a follow-up question from the line of Ritik Tulsian from Concept Investwell. Please go ahead.
Yeah, hi. Thank you for the follow-up. So, sir, I just have one question. That is, currently our run rate in Germany is close to 2 million odd, right? And in the last con call, you said that to achieve break even, we have to have 3 million euros run rate. So, with the Vodafone tie-up and the investments we have made, are you confident of achieving that run rate, or do you have to make more investments? So, basically, I want to know the investment trajectory in Germany.
Yeah, so the current run rate is about 1.5 million.
Okay.
As of this time, after Vodafone cost, it is about 2.5. So we just need to achieve additional 1 million per month to reach break even, and that is what we believe in overall for the H2 we should be able to get there. Because we are seeing repeat purchase rate by the customers, existing customer as well as Vodafone customer. That gives us confidence to reach there.
Okay, so basically we will not have to make additional investments, right? A lot investments.
No, there's no other CapEx or additional OpEx needed to reach there. Because we have seen the repeat purchase behavior of customers that we have acquired previously, and when we extrapolate that behavior on Vodafone or other customers, we reach to the same conclusion that we reach break-even estimate.
Okay, sir. Thank you. That answers my question.
Thank you, Pratik. Appreciate it.
Thank you. Ladies and gentlemen, that would be our last question for today. I now hand the conference back to Mr. Agarwal for closing comments. Thank you, and over to you, sir.
Thank you, operator. So I want to thank all the participants for your time and great questions. If you have any further questions, please feel free to reach Prashant Saraswat at VGL or Amit Sharma at Factors PR India, and we all will be happy to answer your questions. Thank you once again. Thanks all.
Thank you very much. Ladies and gentlemen, on behalf of Vaibhav Global Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.